Hi everyone, I just wanted to put together a short video on making sure that you understand why it's important to use implied volatility to your advantage when buying or selling options. I hate seeing newer traders purchase a call, for instance, and they see that the stock goes up in the right direction, to the right magnitude, within the right time frame, and yet this call still doesn't make money. And that is highly likely due to the fact that volatility has come down or even gotten crushed, and they did not factor that into their trade decisions from the outset. And so, what I want to make sure you get from this video is that you're not buying options when they're expensive. And I don't mean dollars per contract, $5, $10. I mean when the volatility of the underlying is high relative to itself over the last 6 to 12 months. And when I say cheap, I don't mean 25-cent contracts or 50-cent contracts. A contract could be $8 a contract and still be cheap because it typically trades for much more than that if you look at the implied vol chart. So without further ado, let's just get to what I'm looking at right now. And if you look up in the top right corner here, I have a variety of different studies and strategies and things like that. But tonight we just want to focus on implied vol. And you can see here, it's really easy to set up on your platform. I've got the typical candle chart up here, and it's colored red, green, and blue. I'm using the Elder Impulse system. You can read about that on stockcharts.com. They have a nice tutorial, but essentially gives you a sense of when the stock is starting to turn in a certain direction. IV and HV you can set up, and I'll show you that in a moment. And then RSI, just showing overbought and oversold conditions. And so if I right click here, excuse me, I go ahead and I click on studies here, you can see it's really easy to set this stuff up, and I can just pass this on to you. There's no real big secret here. Just pause the video if you need to, set this up in your platform, and you'll have the exact same info as myself. So the point here is that you can see SPY, when it basically fell off a cliff in March because of the pandemic, implied volatility started spiking. And so you might have been buying put options, but you would have had to pay a healthy premium for them for you to make money on those. Conversely, if you had been buying calls, let's say for the ride up here, you may have been right in terms of magnitude and direction, but because volatility was getting slammed, there is a decent chance that your call position did not do nearly as well as you hoped it would do. And that's why it's really important to understand the mechanics of IB before you take on a trade. And I think the best way to illustrate that is with an example. And I know some people shot out some tickers that I had requested, and we can use these tickers as an example in a minute. But I have a little watch list going here. You can see some different symbols. And what I've got, other than the net change, percentage change, etc., I have three columns set up: implied volatility, IV percentile, and put to call ratio. And if you click on the little gear icon, you can set this all up yourself easily by just picking the available items on the left and taking out what you don't want. The concept here, and I have it sorted from least to most, shows you that Visa right now has an implied vol of 28%, which is that high? Is that low? If we go over and we look at Visa, what's going on there? Yeah, Visa, and you've got to look at the option chain here, and you take a look over on the right side. You can see that the options are they're reasonably priced, 28% give or take, which means there's not a lot of expected movement over the next 30 days, more than would be expected with something like Visa before something like an earning announcement or, like I say, an investor day. And so Visa right now is a 28% vol, and it's in the 13th IV percentile, which means relative to the last, going back in time, it is in the bottom 13% of the boundary from here to here, which means it hasn't been this it has been this low essentially 87% of this time frame that we're looking at. And 28% itself is fairly low relative to where it could be. You'll see that obviously IV tends to spike right before earnings announcement. There is one right there. This one, it was spiking. This was just because of the market. But the bottom line here is that if you want to express a bullish view with Visa right now, volatility is cheap. Your best bet would be to buy straight calls. You can buy the stock, but of course, it's not as leveraged and it costs a lot more money. And I'm not saying I'm bullish Visa right here. I'm saying if you wanted to express a bullish view, buying calls would not be the worst idea. I would probably want to wait for a switch here from red to blue to green, and then go ahead and take some September or at least June to September leaps, because you want to make sure you give yourself enough time to be right. So if we shoot now all the way down to the bottom, let's take a look at Blink. And Blink is one of those, I think, EV stocks. I saw some people talking about it on Twitter. Blink is kind of a different beast. If you look at the IV chart here, going back over the last 12 months, you can see that although it's in the 31st, sorry, excuse me, it's in the 41st IV percentile, which means it's essentially for most of this time frame, it's been in the lower half of the boundary. It is still elevated at 150%, which means these options are not cheap. And if we go and we look at Blink, you can see there, compared to Visa, right, the numbers are huge. So if you wanted to express a bullish view right now, go ahead and strictly buying calls is not a smart idea. Because if volatility continues to come down, and currently it is trending down, your calls are going to get crushed, even if you are correct on direction, magnitude, and time frame. Let's just take a quick example here. Um, let's see here. So the stock is trading at 28 and change. The December options expire in 3 days, and the December 30 calls, heck, the December 31 calls are 40-cent bid. So that's several points out of the money with just a few days left. You're paying still a hefty premium here. And frankly, I would not want to do that myself. I would rather buy the stock and sell the calls and take in that premium. And so what I'm trying to get across here is if you wanted to express a bullish view, first of all, I'd like to see a green candle here, a switch from blue to green. I'm very much a fan of using the Elder Impulse system. I would not do it with straight calls. I would either do it as a call spread, which helps to neutralize the volatility. And by neutralize, what I mean is if you're buying an expensive option, you're also selling one too. So that takes implied volatility out of the equation. And now it's just a matter of being right on direction, magnitude, and time frame. The only thing I have against call spreads is you often have to wait until option expiration to max out the value of the spread. And so generally speaking, if you can hit 75, 80, 85% of your max profit, that's pretty much where I'd be taking it off. But that's that's another video. But the bottom line here is if you wanted to express a bullish view with Blink, you could also sell puts if you have enough cash in your margin account, or sell a put spread and take advantage of that implied volatility. But more important, not being a sucker and buying the implied vol and watching the stock either go down and you lose, or it maybe goes up and you still lose because volatility comes down and you bought it when it was too high. So if I search by IV percentile, resort it here, I can see, look at something like Biohaven. Biohaven is a biopharma stock specializing in migraine medication. There's talk of a takeout with this thing going on for some months now. Bottom line here is this is trading in the 63rd IV percentile. So it's trading in the upper third of this time frame here, of this boundary over the last 12 months. The IV itself, 116%, relatively high, 116% right there, you see. It's been higher in the past, and that was essentially when the market was getting smoked. And it's also been lower, right around there. So these points here, November 11th, and right around there, May 14th, those were optimal times to buy straight calls if you wanted to express a bullish view. And you can see that the market did go up, Biohaven did go up after that, and so you may have done quite well, or at least for a few days anyways. But the bottom line is here, if you go and you look at the options, Biohaven, still a little pricey. If you wanted to express a bullish view, you could probably go out and buy the July or the Jan 22 calls so you're not overpaying on those. You see that, how the volatility drops over time? But just to buy straight calls right now, it's just you're trading with one hand behind your back. You're not giving yourself a chance to win because you're paying up for that vol, right? And so if I zoom in a bit here and I wanted to express a bullish view, like I showed you before, I'd like to see probably a break of this trend line. And I want you all, of course, to remember that technical analysis is still, of course, involved in all of this. This is just an aspect of the options pricing model to use in conjunction with technical analysis to improve the odds, put them in your favor. So if I see a break of this trend line and I see volatility still extended here and I want to express a bullish view, I probably would either do it in the form of A, selling a put spread, probably somewhere around here because there's pretty good support at the 80 level right there. Former resistance became support. B, I'd want to buy a call spread, perhaps go out and buy the 80 100s or 90 110s, something to that effect. Or C, my personal favorite, buy the stock if you can afford that much in your account and sell calls against it and take advantage of that implied vol and bring that money into your account. Sell those calls to somebody else who's overpaying for them. Does that make sense? Some people asked for some tickers to be looked at over here, so I'll pop them in there for you. Tesla, I think I put in this list here. I'm going to just sort it by symbol. Tesla is currently trading with a 90% implied vol, and it's in the 33rd percentile, so it's relatively low compared to the rest of the year. And the volatility is sort of somewhere in the middle, not too high, not too low. So if you wanted to express a bullish view, there's really, I want to say, no real wrong way to do that. You could buy calls, but they are bloody expensive, so probably still better off with a call spread. Someone was talking about Roku. The media stock, Roku, is trading with a 63% IV, trading in the 8th percentile. This is really interesting. It is virtually rock bottom over the last 12 months. So volatility, in a sense, has really never been cheaper in this name compared to where it's been over the last 12 months. Roku, look at that, 120%, 90%. It's all the way down here at 60%. Only problem is stock's pretty extended, so to express a bullish view here, I don't think is the best spot for it, even though Vol is saying it's a good time to get long. Maybe if you could wait for a bit of a pullback, to the low 300s or something to that effect, that might be more interesting. But so volatility, I like it in this situation for buying calls on the cheap, but because of the technical pattern, because it's so extended, I'm just not really interested there. The trade desk, I know Kathy Woods has been loading up on this for her ARK funds. Again, if you look over on the left side, you'll see that 50% IV in the 15th percentile. So options here are nice and cheap relative to where it's been. But again, stock is hitting new 52-week highs, hitting new all-time highs. So not the best spot on the chart, in my opinion, to express a bullish view. If you did want to express a bullish view, selling options is not going to bring you in a lot of premium relative to where it's been. So the only real way, the safest way probably to do that would be to buy stock, and at $9.33 a share, not really interested personally. Restoration Hardware, 48% IV, 13% IV percentile. Options are cheap right now. The stock has pulled back. You can see it's made an elder switch from blue to red. So you would definitely want to see some stabilization first. There is a little bit of a gap there that needs to be filled. But if this stock can go from red to blue to green, and the calls are still relatively cheap, and you wanted to express a bullish view, options are out of the way, hey, great. You've got 60 points of upside, and you're not overpaying for the calls. You get where I'm going with that? Last couple here, because I wanted to keep this video under 15 minutes. Copart, look at the IV again, cheap relative to where it's been. The stock is moving higher out of a base. There were buyers, unusual buyers of the January 120 calls a little while back, and they are starting to get paid, and I am one of them, and that's why I'm showing you this chart. But the point here is that there's still another 8-9 points of upside, and calls are cheap. It isn't expensive to get involved relative to a time like over here when you had to pay up whether you wanted calls or puts. RSI is pointing up. This is a nice chart to be involved in, either tomorrow or on a pullback. And finally, someone was asking about Microsoft. Microsoft, we can see, is trading 31% IV, 18th percentile, again, relatively cheap. If you wanted to express a bullish view, I would definitely endorse straight calls, call spreads, bull put spreads, or buying the stock, but not really being a seller of calls if you own the stock, because you're not going to get a lot for it. It's cheap to be ready to play the upside with straight calls. You could go ahead and buy the Jan, Feb, March, 220s, 225s, etc. You can see there it's tightening in a coil and it's ready to make a move. And your calls are going to make money if it goes in your favor because you're not overpaying for volatility. I hope this makes sense. I'm pretty sure it does. I think it was pretty clear. It's really easy to set your platform up, and I hope you enjoyed this video. And if you have comments or questions, feel free to leave them below the video on YouTube. You can also hit me up on Twitter. My handle is CashRocket, and I'm happy to make more videos like this in the future if enough people respond to it. And yeah, that's the bottom line here, guys. Don't overpay for options, and you're already that much further ahead of the guy next to you who's just paying through the nose unnecessarily. Okay? Thanks for watching, and stay safe. Have a great week.